Hi, this is Jack Crooks from Money and Markets TV. The U.S. dollar has been trending generally lower so far this year, and many analysts believe that the Federal Reserve's monetary policy is a negative influence on the greenback. Put simply, the more money printing and quantitative easing the Fed does, and the longer they keep interest rates near zero, the more it degrades the value of the dollar. But the European Central Bank has been pursuing the same ultra-accommodative policies as the Fed. So why isn't the euro tanking? For one thing, the euro acts as a sort of alternative reserve currency and moves inversely to the dollar based on capital flows. But it's not that simple. A more comprehensive answer has to do with something called repatriation. You hear the term a lot in relation to the Japanese yen, and it's one reason the yen stays persistently high even when Japan's economy is struggling. When Japanese investors bring money back home, they're forced to convert their investment capital back into yen, and that boosts the currency's value. It's a similar dynamic with the euro, but the catalysts are different. The story begins before the financial crisis of 2008. At that time, European banks were expanding using mainly dollar-denominated assets. But now the banks are on the ropes, and they're doing everything they can to offload those assets, thus reducing the value of the dollar and giving a boost to the euro. So how long will this shift in flows to the euro last? How long can the currency be able to defy gravity? We can find the answer in the International Monetary Fund's latest Global Financial Stability Report, released 2 weeks ago. The IMF predicts the deleveraging from dollar-based assets will last for about 18 months, ending in the fall of 2013. At that point, or even shortly before that, I believe the ECB will enact additional monetary easing to stem the credit and growth pressures of deleveraging and fiscal austerity. That money pumping will eventually remove the downside support from under the euro. At that point, it doesn't matter if the Federal Reserve still has its own accommodative policies in place. The euro is going to get hammered regardless. As I mentioned, the deleveraging process is likely to take 18 months. But investors already see the writing on the wall. So I believe we'll begin to see the shift in the currency market sooner than next fall. And if the deleveraging sparks some type of systemic panic across the global banking system, it could be much sooner. For that reason, I'd recommend staying away from the euro, a currency that's reliant on economies that are already fighting for their lives. I'm Jack Crooks from Money and Markets TV. Thanks for watching.